In 2008, September, the House of Lehman fell. Lehman was a major market maker in TIPS, Treasury Inflation-Protected Securities. When they closed their doors, TIPS flooded the market. The correlation between TIPS and Treasuries, which is about 98-99%, broke down, and the TIPS moved off its regression line. So Palomino Fund came in, hedge fund, and saw an opportunity that if they bought TIPS and sold Treasuries, they would be able to make money if there was mean reversion. The undervalued would go up and or the overvalued would go down, but there would be a reversion back to the mean. And if you think about the concept of QuantStop looks at thousands of pairs and looks at thousands of pairs that are highly co-integrated and that will tend to mean revert, to co-integrate with each other. And then when they move away from their regression line, 1, 2, 3 z-scores or standard residuals, if you would have traded that, if you would have bought the undervalued and sold the overvalued, in the past, would you have made money? And so it runs a beautiful 5-year back test and tells you what your win rate is, how many trades would have won, would have lost, your average return, your mean return. It's very exciting. It will actually let you know if there is value in trading that. Now, one thing you need to understand is that markets do change and markets do shift. One of the main principles of Dr. Engel's Nobel Prize-winning work was GARSH, General Auto Regression Heteroscedasticity. It was really based on 3 principles: mean reversion, assets tend to mean revert; momentum, there's a behavioral effect called momentum. Assets, buying begets buying and selling begets selling, sort of behavioral effect. And then there is serial correlation, and that's sort of like an echo effect. If it's cold today, it will be cold tomorrow. In fact, it's said that Engels talked about movement or volatility is similar to the weather. We run, at our firm, we run a target risk model really based on Dr. Engel's work. It is the same concept that we look at the volatility of a mix of assets, their covariance, and as their covariance starts to move towards 1, we rebalance the portfolio to get our portfolio standard deviation within a range. This is really nice because we could help our 401k clients shift their portfolio from higher risk assets to low risk assets. And that's how our performance has been so good over these many years, especially in bear markets. We've been able to really cut off that tail, that left tail. So it's important when you run modeling and you look and you use QuantStop as a tool, you want to make sure that your correlations are high enough to where you feel like you have a stable enough beta to beta weight the position to a delta neutral position. So therefore, directional movement is not going to hurt you. The only way you could lose money is if 2 assets continue to move apart if you're trading mean reversion. We saw that happen with the MF Global Corzine when he was trading the Spanish bonds against the German bonds. Why? Because the EU had guaranteed both. The European Union said they guaranteed all debt within the European Union. Of course, the Spanish economy was a faltering economy. The German economy was a very strong economy. So the idea, Corzine said, was, well, we know that these assets have to converge because they're both guaranteed by the EU. So he bought the Spanish bond and sold the German bond. But they kept widening. And I love the quote by John Maynard Keynes: markets can stay irrational longer than you can stay solid. And that's exactly what happened. Corzine, that's happened with long-term capital management. It almost took down the U.S. economy in 1998, and exactly 10 years later, the economy did collapse because of unregulated derivatives. QuantStop not only is a tool to play mean reversion, you can also use it to trade earnings or dispersion. If you think because of earnings an asset is going to outperform its benchmark, I could do that in a delta hedged way. I could do that not just taking a biased right-out view. If I think Netflix is going to have bad earnings and drop much further than, let's say, consumer staples, which is its benchmark, where it's 98% correlated, I can sell Netflix, buy XLK, and if the assets disperse, I could make money if the assets spread apart. away from their regression line. So that's another way to trade it. One of the best tools of QuantStop that really took us a while to really put together and gave my head programmer and his team a lot of fits was using optionality within the pairs trading framework, which is, I believe, the only software on the market that can do that. Now, I like to think of this software as a hedge fund in a box. I learned a lot of these concepts through my hedge fund friends in Chicago when I was teaching a class at DU, what we call the Walk in Chicago. I had the opportunity to learn a lot of these tricks using derivatives to trade, pairs trade, or mean reversion. So I hope that has helped what QuantStop is, and let us know what you think, and thank you.